Welcome to this channel, Tech Explained by a Real Expert. I'm a software engineer with nearly 20 years of experience, here to make tech simple and accessible for everyone. From expert insights and honest reviews to practical tutorials and the latest tech news, it's all right here. Subscribe for smart, reliable tech content. Like the videos to show support. Comment to share your thoughts or request future topics. Let's build a strong, informed tech community together.
What are types of trading? How they work. Who it's for, and a fully developed pros and cons. This will be in a more academic, comprehensive format. So listen carefully. There are many types of trading. Some of them are Forex trading, stock trading, options trading, futures trading, crypto trading, CFD trading, contracts for difference, commodities trading, bond trading, index trading, copy trading, social trading. Let's explain and see what they are, who it's for, what the pros and cons they have for each of them. Don't forget to like, comment, and subscribe my videos if you find them helpful, because it motivates me to continue such work. Now let's go deep dive into each trading types. 1. Forex, foreign exchange trading. Forex trading, or foreign exchange trading, involves the simultaneous buying of one currency and selling of another in the global marketplace. This market operates 24 hours a day, 5 days a week, and is considered the most liquid financial market in the world, with a daily trading volume exceeding 7 trillion. The primary participants include central banks, multinational corporations, financial institutions, hedge funds, and retail traders. How it works. Forex trading is conducted in currency pairs, such as EUR/USD, euro against the US dollar, where the first currency is the base, and the second is the quote. If a trader believes the base currency will strengthen against the quote, they buy the pair, go long. If they think it will weaken, they sell the pair, go short. Currency values fluctuate due to factors like interest rate differentials, inflation, geopolitical events, and economic indicators, e.g., employment reports, or GDP. Who it's for, Forex trading appeals to both beginner and experienced traders. Its low barrier to entry, including small initial capital requirements and the availability of demo accounts, makes it attractive to new participants. However, due to its complexity and volatility, success requires strong risk management and a deep understanding of macroeconomic fundamentals. Pros: highly liquid market. With trillions of dollars traded daily, Forex offers high liquidity, which means orders can be executed quickly at the desired price. Open 245. Unlike stock markets, Forex is open 24 hours a day during the business week, allowing traders to respond to global news and events in real time. Low capital requirement. Traders can start with as little as 50 or 100 due to leverage, although higher leverage increases risk. Wide access to educational tools, brokers and online platforms provide abundant resources and demo accounts for practice. Cons: high volatility can lead to rapid losses. Currency prices can swing dramatically in minutes due to political instability or economic news, making it easy to suffer large losses. Leverage can be dangerous. Although it increases profit potential, leverage can amplify losses just as quickly, often wiping out accounts if not used carefully. Requires deep understanding of economics. Success depends on understanding international finance, central bank policies, and market sentiment. Emotional trading pitfalls. Fast market movements can lead traders to make impulsive decisions without following their strategy. 2. Stock trading. Stock trading is the process of buying and selling shares of publicly traded companies on stock exchanges like the NYSE or NASDAQ. When you purchase a share, you're essentially buying a small ownership stake in the company. Investors trade stocks to profit from changes in the company's share price or to earn dividends over time. The stock market is influenced by company performance, investor sentiment, and broader economic conditions. How it works. Traders buy shares at a low price with the aim of selling them at a higher price for a profit. Stocks can be traded through brokers using various platforms, and the trade execution depends on supply and demand in the market. Some traders focus on technical analysis, chart patterns, while others rely on fundamental analysis, evaluating financial statements and company health. There are different strategies. Day traders buy and sell stocks within a single day. Swing traders hold for several days or weeks. Position traders or investors may hold for months or years, focusing on long-term appreciation. Who it's for, stock trading is suitable for individuals who have an interest in business, economics, and analyzing financial data. It appeals to both short-term speculators and long-term investors. Those who follow corporate news, earnings reports, and market trends tend to perform better in this field. Pros: ownership of real assets. Stockholders own a piece of a real company, which may pay dividends and appreciate over time. Transparent and regulated markets. Stock exchanges are heavily regulated, ensuring fair pricing and protecting investors from major fraud. Variety of investment strategies. From conservative dividend investing to aggressive growth trading, stock trading allows flexibility based on risk tolerance. Access to extensive information. Analysts, media, and tools make it easier to research companies before investing. Cons: market hours are limited. Unlike Forex or crypto, stock trading is only possible during specific hours, usually 9:30 a.m. to 4 p.m. EST. Company-specific risk. A single piece of bad news, like an earnings miss or lawsuit, can significantly reduce a stock's value. Emotional pressure and overtrading. Rapid price movements often tempt traders to act impulsively, resulting in losses. Fees and taxes. Depending on your broker and location, you may face commissions and capital gains taxes that affect your net profits. 3. Options trading. Options are financial contracts that give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price before a specified expiration date. This flexibility allows traders to profit from market movements in any direction and to create advanced strategies that can limit risk or generate income. How it works. There are two main types of options: call options, which give the right to buy the asset, and put options, which give the right to sell it. Options are priced based on multiple factors, including the current price of the underlying asset, time until expiration, and market volatility. Traders use options for various reasons: speculation, hedging existing stock positions, or generating income, e.g., through selling covered calls. Popular platforms for trading options include Thinkorswim, Robinhood, and Interactive Brokers. Who it's for, options trading is generally suited to intermediate and advanced traders who understand market mechanics, technical indicators, and volatility. It's particularly attractive to those who want more strategic flexibility and are capable of handling complex instruments. Pros: potential for large gains with small capital. Options can offer substantial profit potential because you're controlling an asset at a fraction of the cost compared to owning the stock outright. Ability to profit in any market condition. Options allow you to bet on rising, falling, or even neutral markets using various strategies. Defined risk in many strategies. Certain option setups, like buying a call or put, have a maximum loss equal to the premium paid. Useful for hedging. Investors can use options to protect their portfolios from adverse price movements. Cons: complex pricing mechanisms. Factors like time decay, theta, volatility, vega, and the Greeks make options harder to understand and predict. Short lifespan of contracts. Many options expire worthless if not managed properly, which can result in total loss of the premium. Margin requirements can be high. Some strategies require significant margin or collateral, especially when selling options. Risk of misuse. Without proper knowledge, options can lead to large and rapid financial losses due to leverage. 4. Futures trading. Futures trading involves buying and selling standardized contracts that obligate the buyer to purchase, or the seller to deliver, a specific asset at a predetermined price on a future date. These contracts are traded on centralized exchanges, like the Chicago Mercantile Exchange, CME, and the underlying assets can range from commodities like oil and wheat to financial instruments such as interest rates and stock indices. The futures market is essential not only for speculation, but also for hedging. For example, a farmer may use futures to lock in a price for their crops months in advance, while a trader might speculate on the price of crude oil rising or falling. How it works. A futures contract specifies the quantity, price, and delivery date of the asset being traded. Traders enter long buy or short sell positions based on their expectations of future price movements. Unlike spot trading, futures often require only a small initial deposit called margin to control a much larger contract size. This leverage can amplify gains but also increases the risk of substantial losses. Before the expiration date, most traders close their positions rather than take delivery of the actual goods. In some cases, traders roll contracts forward to a later date to maintain exposure without taking physical delivery. Who it's for? Futures trading is generally suited to experienced traders, professionals, or institutions who understand margin, leverage, and market behavior. It also serves as a tool for producers, manufacturers, and corporations that need to hedge against price fluctuations in raw materials or currencies. Pros: standardized and highly regulated. Futures contracts are traded on formal exchanges with strict regulations, ensuring transparency and reduced counterparty risk. Efficient price discovery and liquidity. Futures markets often provide real-time, high-volume trading environments, making it easier to execute large trades quickly and at fair prices. High leverage. With a relatively small amount of capital, traders can control large contract sizes, increasing their potential returns. Broad asset exposure. Futures allow exposure to a wide variety of markets, including commodities, equity indices, interest rates, and currencies, all in a single platform. Cons: significant risk from leverage. While leverage enhances returns, it equally magnifies losses. A small price movement in the wrong direction can trigger a margin call or liquidation. Complex contract specifications. Traders must understand the nuances of each contract, such as tick size, expiration dates, and settlement procedures, which can be confusing. Limited accessibility for beginners. The technical nature and large capital exposure of futures make it difficult for new traders to participate safely. Emotional pressure from margin calls. If a trader's account falls below maintenance margin due to market moves, they must deposit additional funds or face liquidation, a stressful scenario that can lead to panic decisions. 5. Cryptocurrency. Crypto trading. Cryptocurrency trading refers to the buying and selling of digital currencies such as Bitcoin, BTC, Ethereum, ETH, and thousands of other tokens. These assets exist on blockchain technology and operate in a decentralized environment, free from centralized government control. Crypto trading has evolved rapidly, now encompassing various forms such as spot trading, futures, margin trading, and staking. This market is relatively new compared to traditional finance, but it has gained massive popularity due to its accessibility, high volatility, and potential for significant returns. How it works. Crypto trading can take place on centralized exchanges, like Binance or Coinbase, or decentralized exchanges (DEXs) that use smart contracts to facilitate peer-to-peer trades. Traders can buy crypto assets directly in the spot market, or use derivatives like perpetual futures, which allow for leveraged positions without expiry dates. Unlike traditional markets, cryptocurrency markets are open 24/7, providing continuous trading opportunities. Price movements are driven by supply and demand, network upgrades, adoption trends, regulatory news, and macroeconomic factors such as inflation or interest rates. Who it's for. Crypto trading appeals to tech-savvy individuals, speculative traders, and those seeking exposure to high-growth digital assets. It is suitable for both beginners using user-friendly platforms and advanced traders who utilize algorithmic strategies or decentralized finance (DeFi) protocols. Pros. 247 Market accessibility. Unlike traditional financial markets that close on weekends or after hours, crypto markets operate around the clock, allowing global participation at any time. High volatility equals high profit potential. Rapid price fluctuations create many opportunities for traders to profit within minutes or hours, making it ideal for active traders. Diverse ecosystem. Beyond simple buying and selling, traders can engage in lending, yield farming, liquidity provision, and staking, all of which provide additional revenue streams. Global, decentralized access. Anyone with an internet connection and a digital wallet can trade cryptocurrencies without needing a bank account or government ID on decentralized platforms. Cons. Extreme volatility can lead to severe losses. While price swings offer profit potential, They also expose traders to sudden and unpredictable losses that can wipe out capital quickly. Regulatory uncertainty. As governments grapple with how to regulate crypto, rules are constantly changing, and some assets may become illegal or delisted. Security risks, hacks, rug pulls, phishing attacks, and platform failures are common in the crypto space, especially when using unregulated or new services. Lack of investor protection. Many crypto platforms do not offer the same level of insurance or recourse as regulated brokerages, leaving traders vulnerable to platform failures or fraud. 6. CFD, contracts for difference trading. CFD trading allows individuals to speculate on the rising or falling prices of financial markets without owning the underlying asset. A CFD is a contract between a trader and a broker to exchange the difference in the price of an asset from the time the contract is opened to when it is closed. CFDs can be used to trade a wide range of assets, including stocks, indices, commodities, Forex, and cryptocurrencies, all from a single account. This makes them an incredibly versatile trading tool, particularly in markets like the UK, Europe, and Australia, where they are legal. How it works. When you open a CFD position, you're entering into an agreement with your broker to speculate on whether the price of the asset will rise or fall. If the market moves in your favor, you earn the price difference as profit. If it moves against you, you pay the difference as a loss. CFDs are traded on margin, meaning you only need to deposit a fraction of the full value of the trade, amplifying both potential gains and losses. CFD trading is typically done on online platforms like IG, Plus 500, and CMC markets, and is known for fast execution and a wide variety of markets available. Who it's for. CFDs are suitable for traders who want flexible, leveraged exposure to global markets without the complexity of owning physical assets. It appeals to those looking to speculate short-term and manage diverse assets in one account. However, they are not recommended for U.S. residents, where CFDs are banned due to regulatory restrictions. Pros. Trade multiple markets through one platform. CFDs give traders access to stocks, Forex, indices, commodities, and crypto, eliminating the need to use multiple brokers or services. Ability to go long or short easily. Traders can profit from both rising and falling markets without needing to own the asset or borrow shares to short. High leverage. With low margin requirements, traders can control larger positions, maximizing potential returns on smaller capital. Fast execution and low entry barriers. CFD brokers often offer free demo accounts, user-friendly interfaces, and fast order processing. Cons. Leverage magnifies losses. While you can amplify gains, you can also lose significantly more than your initial deposit if markets move against you. No ownership of the underlying asset. CFD traders do not receive dividends or voting rights, making them purely speculative instruments. Spreads and fees can eat profits. Brokers typically charge a spread on each trade, and overnight financing fees can accumulate quickly on longer-term positions. Not legal in the U.S., CFDs are banned by the SEC, so U.S.-based traders must use other financial instruments, limiting accessibility. Perfect. Here's the final part of your fully expanded research on financial trading types, covering commodities, bonds, index, and copy social trading in the same detailed format. 7. Commodities trading. Commodities trading involves the buying and selling of raw materials or primary agricultural products. These commodities are typically divided into two main categories. Hard commodities, which include natural resources like gold, oil, and metals, and soft commodities, which are agricultural products such as wheat, coffee, and cotton. Commodities are traded on regulated exchanges such as the Chicago Board of Trade, CBOT, and the New York Mercantile Exchange, NYMEX, usually through futures contracts, though they can also be accessed via ETFs, options, and CFDs. Trading commodities allows participants to speculate on price movements or hedge against market risks tied to physical goods. How it works. Traders can either take physical delivery of the commodity, which is rare in speculative trading, or close the futures contract before it expires. Prices are influenced by a wide array of factors including geopolitical events, weather patterns, supply chain disruptions, and economic data, such as inflation or interest rates. For instance, if a drought is expected to reduce wheat supply, traders might buy wheat futures, anticipating a price increase. Conversely, an oversupply of crude oil might drive prices down, prompting short positions. Who it's for. Commodities trading suits individuals who understand or want to analyze global supply chains, economic cycles, and geopolitical developments. It is used by a mix of speculators seeking profit from price volatility and hedgers such as farmers, mining companies, or airlines looking to protect against price fluctuations in raw materials. Pros: exposure to global economic trends. Trading commodities allows investors to capitalize on macroeconomic trends like inflation, currency shifts, and industrial demand. High volatility equals opportunity. Commodity markets often move sharply due to events like war, weather changes, or OPEC decisions, offering strong profit potential to those who forecast accurately. Diversification. Commodities often have a low correlation with stocks and bonds, making them a valuable tool for portfolio diversification. Useful for hedging. Producers and consumers of commodities can lock in prices to protect themselves against future price changes, reducing operational risk. Cons. Requires deep market understanding. Successful commodity trading depends on a complex mix of fundamentals, including weather, geopolitical news, and global demand cycles. High leverage can be risky. Many commodity instruments, especially futures, are leveraged, which can result in large losses from small market movements. Physical delivery risk in futures. If a contract is not closed before expiry, there's a theoretical obligation to take or make delivery, which traders must be careful to avoid. Subject to external shocks. Commodities can be especially sensitive to unforeseen events, such as embargoes, pandemics, or political unrest, which makes them unpredictable. 8. Bond trading. Bond trading involves buying and selling debt securities issued by governments, municipalities, or corporations. When you buy a bond, you are essentially lending money to the issuer in exchange for regular interest payments, called coupons, and the return of the principal at maturity. While some investors hold bonds to maturity for steady income, bond traders speculate on interest rate movements and credit risk, buying and selling bonds to profit from price changes. Bonds are traded both in centralized exchanges and over-the-counter OTC markets. How it works. Bond prices move inversely to interest rates. When interest rates rise, bond prices fall, and vice versa. Traders monitor central bank policy, especially the U.S. Federal Reserve, inflation data, and economic indicators to anticipate rate changes. Credit risk, the chance that the issuer will default, also affects pricing, especially in corporate and high-yield bonds. Bonds are typically issued with fixed maturities, e.g. 2, 5, 10, or 30 years, and traders often deal in secondary markets to exploit pricing inefficiencies or shifting yield curves. Who it's for. Bond trading is suited for conservative investors seeking lower volatility and steady income, as well as institutional traders and hedge funds aiming to profit from macroeconomic shifts or portfolio rebalancing. It also appeals to risk-averse individuals who prioritize capital preservation over high returns. Pros: predictable income. Bonds pay regular interest, providing a reliable income stream for retirees or conservative investors. Lower volatility than stocks. Bond prices are generally more stable, especially in government securities like U.S. Treasuries, making them a safer haven during market downturns. Wide range of options. From ultra-safe government bonds to high-yield corporate debt, there are many types of bonds to suit different risk profiles and strategies. Useful for portfolio diversification. Bonds are often negatively correlated with stocks, meaning they can stabilize overall portfolio performance during equity market volatility. Cons: interest rate risk. If interest rates rise, the market value of existing bonds typically falls, leading to capital losses for bondholders. Lower returns. Compared to stocks or crypto, bonds usually offer smaller returns, making them less attractive for aggressive investors. Credit risk. Especially in corporate bonds, there is a risk that the issuer may default on payments, leading to losses. Liquidity issues in some markets. Certain types of bonds, especially municipal or corporate bonds, may be hard to sell quickly without impacting price. 9. Index trading. Index trading involves buying or selling a group of stocks that represent a specific segment of the market, such as the S&P 500, top 500 U.S. companies, NASDAQ 100, tech-heavy U.S. stocks, or FTSE 100, UK companies. Traders use index trading to gain exposure to an entire market segment rather than individual stocks. Indices themselves are not directly tradable, but they can be accessed via exchange-traded funds, ETFs, futures contracts, or contracts for difference, CFDs. These instruments mirror the price movements of the underlying index. How it works. Traders speculate on whether an index will rise or fall based on economic indicators, earnings seasons, geopolitical news, and investor sentiment. For example, if an economic report shows strong U.S. job growth, traders might go long on the SP 500 ETF SPY, expecting the index to rise. Index trading is often used for broader market exposure or as a way to hedge other positions. It's also favored by algorithmic and institutional traders who focus on overall market trends rather than individual company performance. Who it's for, index trading is ideal for traders who prefer broad exposure to the market and want to avoid the volatility of individual stocks. It's also beneficial for beginners who want to trade based on macroeconomic trends without needing to research each company. Pros: instant diversification. Buying an index gives exposure to dozens or hundreds of companies, reducing company-specific risk. Simplified research. Traders can analyze economic trends or central bank policies rather than diving into individual earnings reports. Liquid and cost-efficient. Index, ETFs, and futures are highly liquid and often come with lower fees than trading multiple individual stocks. Strong hedge potential. Index instruments are widely used to hedge against systematic risk in a portfolio, especially through futures or inverse ETFs. Cons: limited upside compared to individual stocks. While safer, indices usually grow slower than a well-chosen individual stock with high growth potential. Still exposed to market-wide crashes. During events like the 2008 crisis or COVID-19 pandemic, entire indices can drop sharply, just like individual stocks. Tracking error in some instruments' ETFs may not perfectly replicate the index they follow due to fund fees or rebalancing differences. Leverage risks. In future CFDs, leveraged index products can result in amplified losses, especially during volatile market swings. 10. Copy trading. Social trading. Copy trading, also known as social trading, is a method that allows traders to automatically mirror the trades of experienced investors. Instead of making independent trading decisions, users select a professional or high-performing trader to copy, and every trade that person executes is automatically replicated in the user's account proportionally. This method is available on platforms like eToro, ZuluTrade, and Naga, and often includes social features like profiles, public performance stats, and community discussion. How it works: traders browse a list of available professionals, each with statistics like return rates, drawdowns, win-loss ratios, and number of followers. After choosing someone to copy, a set amount of capital is allocated to that trader. The system mirrors the master trader's positions in real time, adjusting for the size of the copier's account. Copy traders often retain some control. For example, they can set stop-loss limits, close trades manually, or stop copying at any time. Who it's for: copy trading is most suitable for beginners who lack experience, time, or confidence to trade on their own. It also appeals to passive investors who prefer a set-it-and-forget-it model. However, even experienced traders sometimes use it to diversify their strategies or test new markets. Pros: beginner-friendly access. Copy trading provides a direct path to participate in markets without needing in-depth trading knowledge or skills. Time-saving. There's no need to monitor charts or research. The professional trader does the heavy lifting. Learning opportunity. Watching how top traders manage risk and make decisions can provide valuable insights for future self-directed trading. Customizable risk. Users can adjust trade sizes, use protective limits, or pause the strategy if performance declines. Cons: reliance on third parties' performance depends entirely on someone else's decisions, which may not always align with your goals or risk tolerance. Lack of accountability. Some traders on social platforms take excessive risks to appear successful in the short term, leading to major losses when markets turn. Fees and performance commissions. Many platforms take a percentage of the profits or charge additional fees, which can reduce net returns. Overconfidence in historical performance. Past returns do not guarantee future results, and blindly following someone can lead to unexpected losses. Absolutely. Here's a clear and structured conclusion to tie together everything you've learned about the major types of financial trading. Conclusion: understanding financial trading in a diversified landscape. Financial trading is a vast and dynamic field, encompassing a wide variety of markets, instruments, and strategies, each with its own purpose, complexity, and risk profile. Whether you're seeking fast-paced speculation, long-term investment, passive exposure, or professional-grade strategies, there's a trading type tailored to your goals, capital, and temperament. Key takeaways: Forex trading offers high liquidity, round-the-clock access, and global economic exposure, but its use of leverage and rapid volatility demand discipline and education. Stock trading remains one of the most accessible and well-understood forms of trading, offering real ownership and long-term growth, but it requires company-level research and emotional control. Options and futures introduce powerful tools for leverage, risk management, and advanced strategies, but they require a firm understanding of contract mechanics and pricing models. Cryptocurrency trading provides new frontiers of opportunity, innovation, and 247 markets, though it comes with significant volatility, regulatory uncertainty, and security risks. CFD trading offers a simplified, flexible gateway into almost all markets without owning the underlying asset, but high leverage and spreads can lead to quick losses if not properly managed. Commodities trading lets you profit from the real-world supply and demand dynamics of raw materials, but it demands understanding geopolitical and seasonal factors. Bond trading focuses on income and stability rather than rapid gains, making it ideal for conservative investors but vulnerable to interest rate changes and inflation erosion. Index trading enables broad exposure to the market through a single position, making it efficient and diversified, though it still follows the ups and downs of the economy as a whole. Copy trading allows newcomers to participate passively by following experienced traders, but it shifts the burden of risk management and decision-making to others, which requires careful oversight. Final reflection: there's no one-size-fits-all answer to the best type of trading. The ideal path depends on your financial goals, risk tolerance, time availability, and willingness to learn. If you want speed, liquidity, and macro exposure, Forex or index trading. If you're looking for ownership and long-term investing, stock or bond trading. If you're a strategic thinker comfortable with complexity, options or futures. If you love tech and 247 markets, crypto trading. If you're a beginner seeking automation, copy social trading. If you want to diversify or hedge against inflation, commodities or bonds, then leave a comment and I will definitely come up game with the topic you want to.
Thanks for watching. I really appreciate you taking the time to check out my video. If you enjoyed it, don't forget to like, comment, and subscribe for more content. Your support means the world to me and helps the channel grow. Stay tuned for more videos, and let me know in the comments what you'd like to see next. See you in the next one.